Bitcoin ready to break all-time high. Why do we believe we're in the early stages of a new cycle for Bitcoin and other crypto assets? There are three catalysts at play here. The first is the next Bitcoin halving event happening in April 2024. The second is the liquidity expansion cycle expected in 2024. And the third is the pending approval of Bitcoin ETF by the SEC in early January. These may seem complicated to you, but let's break them down in simple terms in this video so you can capitalize on this golden opportunity. Before we delve into the details, please hit the subscribe button so you get more videos like this. The typical structure of a crypto market cycle follows the major events. Bitcoin's price peaks at a new all-time high, then it suffers a painful 80% or so drawdown. The price eventually bottoms almost exactly 1 year after the prior cycle's high. Bitcoin starts to recover and takes about 2 years to reach a new all-time high. Bitcoin continues to rally for another year before topping out at its next cycle high. Then the cycle repeats. The last few cycles have followed this playbook to a T. The consistency of these cycles isn't by coincidence. It's driven by bigger, more powerful macro trends, and one that lies at the very heart of Bitcoin's value proposition. Bitcoin is not an inflation hedge in the way many believe it to be. Bitcoin is not a hedge on the Consumer Price Index, or CPI. It's a hedge against currency debasement. Currency debasement is like watering down a drink. Imagine you have a glass of pure orange juice, but to make more drinks without buying more juice, you start adding water to it. The juice still looks the same, but it's less orangey with every glass you make. This is similar to what used to happen with money, especially when coins were made of valuable metals like gold and silver. In the past, if a government needed more money, they would melt down these gold and silver coins and mix in less valuable metals, like copper. They would then make new coins that still looked like the old ones but had less gold or silver in them. The coins had the same value stamped on them, but they were worth less because they had less precious metal. This is like making more diluted orange juice and still calling it pure juice. Just like how people wouldn't pay the same for watered down juice, over time, people realized these new coins weren't as valuable. This meant prices went up, and people needed more coins to buy the same things. This is similar to when you hear about prices going up nowadays, which we call inflation. In modern times, we don't use gold and silver coins, but governments can still debase currency in a way. They do this by creating more money, like printing more bills. When there's too much money in circulation, each bill's value goes down, and again, prices for things go up. So, currency debasement is like watering down a drink. It's still the same drink, but with less of the good stuff in it, making it less valuable. That distinction is important because currency debasement is driven by monetary inflation and the expansion of central bank balance sheets. In essence, Bitcoin is of the most leveraged bets on an expansionary liquidity environment. And the Federal Reserve is expected to cut the interest rate sometime in 2024 and the liquidity will expand again, aligning well with the Bitcoin key event, the so-called Bitcoin halving. Bitcoin is expected to enter the fourth halving in April 2024. Imagine Bitcoin as a digital gold mine. In this mine, instead of digging with pickaxes, people use computers to solve complex puzzles. These people are called miners, and when they solve a puzzle, they get rewarded with Bitcoin. This is how new Bitcoins are created and enter circulation. Now, Bitcoin halving is like a rule in this digital mine that cuts the rewards for mining in half every so often. Initially, when a miner solved a puzzle, they got 50 Bitcoins. But this reward doesn't stay the same forever. Approximately every 4 years, the reward for solving a puzzle is cut in half. So, after the first 4 years, the reward went down to 25 Bitcoins. Then 4 years later it went down to 12.5, and so on. Why does this happen? It's a built-in feature of Bitcoin to control how many new Bitcoins are created. By reducing the reward, the creation of new Bitcoins slows down. This is a bit like if a real gold mine started giving out half as much gold to miners. After certain periods there would be less new gold coming out of the mine. This halving event is important because it helps to make sure that there won't be too many Bitcoins all at once, keeping the supply limited. Just like gold, part of what makes Bitcoin valuable is that there's not an unlimited amount of it. The halving helps keep Bitcoin scarce, and scarcity can make things more valuable. So, Bitcoin halving is a process that reduces the amount of new Bitcoin rewarded to miners, ensuring that the total number of Bitcoins in circulation grows more slowly and remains scarce. And scarcity drives up prices. It just so happens that each halving has lined up with an expansionary liquidity environment. The next halving is expected to occur in April 2024, which once again looks to be right on cue. That's not to say the halving isn't important. It's a strong narrative that can certainly pour fuel on a bullish uptrend, especially if we see a spot BTC ETF approved ahead of time, given liquidity upcycles tend to turbocharge fund flows. Recently, the crypto world has been buzzing about whether the Securities and Exchange Commission (SEC) will give the green light to these Bitcoin ETFs. It's a pretty big deal because it could change how people invest in Bitcoin. Until now, the SEC has been pretty hesitant. They've been worried about things like fraud risks in the crypto market. But here's the interesting part. BlackRock, which is like this financial giant, updated their ETF proposal to make it more appealing to the SEC. They're saying, okay, we can do these transactions in cash instead of just Bitcoin. That's a pretty smart move because it seems to match what the SEC wants to see. There's also this cool thing called a surveillance sharing agreement in BlackRock's proposal. Basically, it's a way to keep an eye on the market and prevent any sneaky business, like market manipulation. This could be a game changer because it addresses one of the SEC's big worries. And guess what? The conversations between the SEC and the ETF folks are getting more serious. They're really digging into the details, which suggests that the SEC is giving this whole idea a closer look. So, we're all waiting to see what happens. The SEC has set some deadlines. They're supposed to decide on BlackRock's ETF by mid-March. If they say yes, it'll be huge for the crypto market. It'd be like a big thumbs up for Bitcoin in the mainstream financial world. Bitcoin's price bottomed in November 2022, almost exactly 1 year after its last cycle peak. If Bitcoin follows its historical playbook, that would imply a new all-time high by the fourth quarter of 2024 and its next cycle peak roughly a year after that. These positive catalysts have driven up not only Bitcoin price recently, but also other related company stocks like Coinbase, Marathon Digital, and Riot Platforms. Even Nvidia, whose GPUs are used to mine the cryptocurrencies, stand to benefit. And if we are in the early innings of a new global liquidity uptrend, Bitcoin and crypto assets should outperform considerably over the next 12 to 18 months, along with these associated company stocks. So don't miss out on this great investment opportunity. Thanks for watching.